right, so now that you understand how I analyze businesses, I'm going to do some live analysis right now. All right, so we have asked you to vote, and these are all the votes. We had many people voting for Tesla. That was number one. I'm not surprised because it's a hot stock. People love hot stocks, right? Apple, Amazon, Facebook, Intel, Boeing, AMD, Microsoft, Alphabet, Neo, Square, Shopify, Nvidia, so on and so forth. Now, I don't have the time to analyze all of them, okay? So I'm just going to analyze two of them, but I will give you my comments on the rest of them. Is that cool, guys? Let me check on some of the questions coming in. Okay, great. Okay, so shall we look at the first one? Shall we look at the first one? The first one we're going to look at is a Tesla. Okay, now before that, I'm curious, guys. How many of you have played this game called Shag, Marry, Kill? I'm just curious. If you have, say yes. Shag, Marry, Kill. Now, in Singapore, we call it Shoot, Shag, Marry. It's a game where we choose three people we know, right? So if I'm a guy, my friends would give me three girls that I know. And I have to choose one of them to shag, one of them to marry, and one of them to kill, right? Shag, marry, kill. So now, if you don't understand, shag means it's a British slang. Shag means to have a one-night stand. Is to, you know, right, shag, right? So some girls you want to shag. You don't want to marry them. You want to shag them. Some girls you want to marry them, and some girls you want to just kill them, right? Now, same thing with guys, okay? Shag, marry, kill. So we're going to play Shag, Marry, Kill with stocks, okay? So there are some stocks that you don't want to touch them. You want to kill them, right? They're so bad, you want to kill them. There are some stocks that you want to invest in them. We call them marry. And there are some stocks that you just want to have a one-night stand, right? It's a quick, short-term trade, get in, get out, and that's it, right? Now, what's the difference? When I invest in a stock, okay, I do not put a stop loss. Because when I invest in a stock, my win rate is 100%. I don't need a stop loss because I know I'm definitely going to make money, right? Because it's got very strong fundamentals. But when I enter a stock for trading, it's a one-night stand, I have to put a stop loss. It's kind of like in a one-night stand, you have to use protection, okay? Because you don't know the person really well. The person looks hot, but you don't know, what's going to happen. So you're going to put a stop loss. You're going to use protection in trading, right? And in trading, it's mostly based on technicals. So as we run through the stocks, we're going to look at it. Which stocks are we going to invest in, marry, trade, shag, or we're not going to touch, going to kill them? Does this make sense? Okay. So the first one that you voted for is Tesla. Let's look at Tesla. Okay. So again, I'm going to go through the criteria. Let's go through the criteria, right? Now, first of all, before you look at a stock, you have to understand the business behind the stock. Because you're investing in the business, okay? What does Tesla do? Now, Tesla is basically a leading electric vehicle and autonomous vehicle player. So basically, they're the leader in electric vehicles and as well as self-driving vehicles, right? They're a leader in the area. And their auto business, as you can see in dark blue, is the majority of their business. A smaller part of their business is in energy generation and storage. That's a small part of their business. Okay, and of course they've got their SpaceX and all those things, which it's still a pipe dream, right? It's not really profitable yet. So the main business will be autos and energy storage. Okay. So with that, let's go through the steps. What's the first step? Does it have a track record of consistently increasing sales revenue, net profit, and cash flow from operations? Let's check it out. Okay, so this is Tesla over there. This is 2016, 2017, 2018, 2019, and the last 12 months. Okay. So revenue, 7 billion, 11 billion, 21 billion, 24 billion, 25 billion. Looks good, going up consistently. Revenues are growing. How about net income, net profit? Now, because it's a relatively new business, they have not been profitable except recently, right? So you can see it lost 600 million, lost 1.9 billion, lost 900 million, lost 800 million. And in the last 12 months, they managed to make some money at last. They made $368 million. So it doesn't have a really strong track record yet. It's just starting off. But the good news is it's making some money right now, $368 million in the last 12 months. Okay, now let's look at their cash flow. Now, there are two things I look at. First would be cash flow from operations. So negative cash flow, which means more money is going out than money coming in. Negative cash flow, they turned cash flow positive 3 years ago, 2.4 billion, 2.7 billion. So, okay, cash flow is starting to look positive. Now, free cash flow is basically cash flow from operations after deducting their capital expenditures, okay, which is over here. So it's negative, 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 just turned positive. So in terms of the first step, Tesla doesn't have that 5-year track record that makes me comfortable. But the good news is that they are just starting to get profitable. They're starting to get cash flow positive. Okay? So that's the good news. Now, next question. Do they have a wide economic moat? Yes or no? Okay, question. Do they have a wide moat? Do they have a wide moat? Do they have a narrow moat? Or is there no moat? Which one is it? The answer is, okay, now you may say, what's the difference? Usually a wide moat company, a company with a wide moat has little or no competition. Little or no competition. Narrow moat means many competitors in that same industry. No moat means tons of competitors competing on price. Now, Tesla's main business is in the auto industry, cars. Now, let me ask you this. In the auto business, are there many competitors or no competitors? Answer is many competitors in the auto business. In fact, if you look at electric vehicles, if you just focus on electric vehicles, which is their niche, you can see Tesla sales 245 billion, right? BYD from China 227, BAIC, BMW, Nissan, Rowe, Chery, Hyundai, Renault, Volkswagen. In other words, it has many, many competitors. So it's definitely not a wide moat. Okay? It's definitely not a wide moat. Now, is it a narrow moat or is it no moat? Question, does it have high switching costs? Once you use a Tesla, does it mean you will never change to another brand? Are you locked into that brand forever? No, there's no switching costs. There's no network effect. There are no high barriers to entry because many other companies can make an electric vehicle. Economies of scale, no. Brand monopoly, debatable, right? So all in all, I would say that My take is that Tesla has a narrow moat. I would say it's a narrow moat. Okay. But if you go to Morningstar, which is the #1 rating agency, they rate Tesla as having no moat. It's got no economic moat. So it fails my second step. It fails my first step. It doesn't have a 5-year track record. It's got no moat. Okay. Now, if you look at this chart, this looks pretty interesting. The one in orange is the revenue. Now, which out of all the competitors, Tesla, Toyota, Volkswagen, GM, Honda, right? Among all the car manufacturers, which has the most revenue? Toyota, Volkswagen, and BMW. These are their sales revenue. Tesla's sales revenue is down here. But the blue is their stock value, the stock price. Tesla is selling at this price, but is delivering the sales. Toyota, Volkswagen, and BMW has a lot more sales. They sell a lot more cars, but they are priced much lower. So you can ask yourself this question: if you want to buy a car company, which one gives you more value? Now, I have to make a disclaimer. Personally, for me, I will never, ever, ever buy an auto company. Whether is it Volkswagen or Toyota or Tesla, I'll never buy a car company. Why? Because the industry is very competitive and the entire industry does not have a wide moat. Now, that's for me, okay? I don't know for you. I'm not telling you what to buy or sell. I'm giving you my opinion. Okay, next. How about debt? Okay. Now, there are a few things I look at to tell when a company has too much debt. Now, this is Tesla. The red is their debt. Look at their debt. Their debt is much higher than their cash. Okay, so that scares me. Their debt is increasing faster than their cash. Okay. Now, debt to EBITDA ratio. This is a ratio where I only invest when the debt to EBITDA ratio is less than 3. The higher, the more dangerous it is. And currently Tesla has a debt to EBITDA ratio of 4.43 that fails my debt criteria. It's got too much debt for me to be comfortable with buying, right? Interest coverage ratio. Is the company able to cover its interest from its profits? How many times can it cover its interest expenses from its profits? I look for an interest coverage ratio of more than 3 times. Tesla has got an interest coverage ratio of 1.76, which is much lower than 3. That fails as well. All right. So there you go. Okay. It has already failed 3 steps. Now, what is the projected growth rate of Tesla? You can see that the long-term growth rate of Tesla is 60%, 51 median. So I usually take the medium growth rate. So Tesla's profits are projected to grow at 51% a year. 51% a year growth rate. Okay. Now you can see that in the last 5 years, their sales have grown by 50%. So if we assume that they continue to grow at 50%, we can take a 50% growth rate. Okay, I'm going to assume Tesla is going to grow at 50%, and I'm going to calculate the intrinsic value of Tesla. All right, the intrinsic value of Tesla. Now, when I calculate an intrinsic value of a company, I either use a 20-year discounted cash flow analysis, or I use a 10-year discounted cash flow analysis. Okay. Now, usually for companies that have a wide moat, I believe that they've got a wide moat, I use a 20-year discounted cash flow. If they have a narrow moat or no moat, I use a 10-year discounted cash flow. So for Tesla, it has a narrow moat. So I should use a 10-year discounted cash flow. In other words, I will project the future cash flow for the next 10 years and discount it to present value. Now, if I do that, what do I get? Okay, let me see. For some reason, I can't find it. Darn it. Where did I put it? Give me a second, guys. Where did I put my Tesla valuation? Okay, that is not too good. I can't find it. Good thing I did a screen capture. Okay, it's good. Sorry. I did a screen capture. I'm going to show you the screen capture because I can't find the original file. Okay. Now, this is a 10-year discounted cash flow of Tesla. Okay. Now, you can see that the growth rate I've used is 51% for the next 5 years. And for the next 5 years after that, I halve it to 25%, which is what I always do. The current cash flow is 77.99 billion. That's the free cash flow. That's the total debt. And that's the total cash, right? So if you put in these numbers, the intrinsic value of Tesla is $240. That's right. I'm not kidding. Tesla is worth $240 per share for a 10-year discounted cash flow. And currently is selling at $1,500. So it is 500% overvalued. Okay? Now some of you may argue, say, but Adam, what if you use a 20-year discounted cash flow? Fine. You know what? Let's use a 20-year discounted cash flow, which I usually won't do, but let's do that. Now, this is based on the 20-year discounted cash flow. Same thing, 799 billion, 12 billion in debt, 8 billion in cash, 51% growth for the first 5 years, 25% for the next 5 years, drop to 4% for the last 10 years. This is the GDP growth rate of the economy, and this is what I do for all companies. Same thing with the next one. Now, based on the 20-year discounted cash flow, Tesla is worth $687. That's the intrinsic value. And so selling at $1,005, it is 126% overvalued. Okay, so let me write that down for you. Tesla is at $1,500. It is actually worth $687, optimistically. But if you ask me, it's worth $200. But let's use 687, which is the most optimistic figure I can get. So what does it mean? It means if you buy Tesla today, there's a chance that Tesla could drop to 687 and you lose half your money. Okay? Now, am I saying Tesla's going to drop tomorrow or next week or next year? I'm not saying that. Because Tesla is a hype stock. People are hyped up. People are buying it. Tesla's doing a share split. So more people could buy it. And sure, it could go up another 50%. I'm not denying it. It could go to $2,000, right? So Tesla could go up by 50%, but it could also drop by 50%. So based on a risk to return ratio, I will not invest in the stock. Okay. Now, again, that's my opinion. You could disagree with me, but that's my opinion. Does it make sense? So Tesla, let's play Shag, Marry, Kill. Do we want to marry it? No freaking way. Kill it? Maybe not. We could do a short-term trade on it. We could trade it short-term where you put a stop loss. You could do that, but I will not invest in it. All right. So that's Tesla for you. Hope that was useful. All right. Really appreciate it. I know that for some of you, it's late at night. Keep it up. All right. We'll take another, 30 or 40 minutes or so. And if you've got more questions, I don't mind hanging around. I've got nothing else to do today. Okay. So again, my final word on Tesla. So Tesla is a stock that I would never invest in. Why? Because it doesn't have a wide moat. It doesn't have a strong track record. The debt is too high, and it's way overvalued right now. So not something I would invest in, but it's just something that I could trade. I could do a one-night stand. I could share. Sure, right? We could trade it for the short term. And it's a pretty interesting stock to trade. Now, remember that in trading is called a greater fool's game. A greater fool's game. Why? Because if you buy the stock, you are a fool. But it is okay being a fool if you can sell it to a bigger fool who's willing to pay a higher price than you. And if you cannot find a bigger fool, guess what? You're the biggest fool, right? Yeah. So trading is a greater fool's game. Always remember, when you buy a stock for trading, you are a fool because you're paying a ridiculous price, but you're selling it to a bigger fool than you. And that's fine. You can still make money, all right? So if you look at Tesla, you can see that the trend is pretty consistent, right? So you've got a wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down, right? So you can see it finds support at the moving averages over there, okay? And recently it found support at the 18 moving average, all right? Sorry, the 40 exponential moving average over there, the blue dotted line. So usually I like the stock to retrace to a moving average and bounce off. You can see it's got high relative strength, okay? Force index is expanding, so high volume, high relative strength, okay? And the parabolic SAR is bullish. So yeah, it will probably go up more in the short term. It has momentum, so that could have been a short-term trade, okay? But again, in trading, you've got to put a stop loss, right? You've got to put a stop loss. And again, in our trading courses, our professional stock trading courses, we go into detail where we place our stop losses and stuff like that. That's not the focus on today's session, all right? Most of the time when I trade stocks, I trade using options. And I'll be covering that tomorrow. So tomorrow, I'll show you how I can use options for short-term swing trading as well. So please be there tomorrow at the same time. We're going to start. Tomorrow's going to be on options trading. Okay. All right. Let's go to the next stock that you guys picked, and it's none other than Amazon. So we're going to go through the same steps as we did with Tesla, and let's see if Amazon meets those steps. Okay. So what's step number one? Track record. Does it have a track record of consistently increasing sales revenue, net profit, and cash flow from operation? Let's check it out. First of all, how does Amazon make money? Amazon's main revenue comes from its online stores, obviously e-commerce. It's its number one business. Its second biggest business is Amazon Web Services, or AWS, that is offering cloud computing solutions to businesses. So main business, e-commerce. Second biggest business would be cloud enterprise solutions. Okay. And of course, it also has smaller businesses in advertising and stuff like that. Okay. So again, 52% of the sales are from e-commerce, and 12% is from its Amazon Web Services. Now, this 20% from third-party sellers is also, we also count that as e-commerce. So total is about 72% e-commerce and 12% will be cloud enterprise solutions. Let's look at the financials. So total revenue, sales, right? 2016, 2017, 2018, 2019, last 12 months. So in 2016, Amazon recorded $135 billion in sales. Next year, 177 billion, 232 billion, 280 billion, 321 billion. Is it increasing consistently every year? Yes or no? Yes. Net income, 2 billion, 3 billion, 10 billion, 11.5 billion, 13 billion. Is the net profit increasing consistently? Yes or no? Yes, it is. Next, cash flow from operations. How much cash is it generating from its business? Cash is the most important thing. So the first thing is we look at cash from operations and free cash flow. Okay, so 16 billion, 18 billion, 30 billion, 38 billion, 51 billion. So again, its cash is increasing consistently. Free cash flow, 9 billion, 6 billion, 17, 21, 26. Right? There was a bit of a dip over here and then all the way up. So it has a fantastic track record. Okay, that passes the first step. Second step, does it have a wide economic moat? Remember, wide moat means little or no competition. Narrow moat, many big players. No moat, tons of competitors. For Amazon, you can see that the moment you mention e-commerce, everyone thinks of Amazon, except in China. In China, they think of Alibaba, right? So it's either Alibaba in China, Amazon in the US. So it has a brand monopoly. Does it have economies of scale? You bet. It can buy stuff cheaper than anyone else and sell it more economically than anyone else, right? High barriers to entry, network effect. Okay, so it's got all these things. Now, in terms of e-commerce, look at this chart. Amazon has a 47% market share. What is the nearest competitor? eBay, 6% market share. Walmart, 4% market share. Apple, 3% market share. Home Depot, 1% market share. So in terms of e-commerce, Amazon is king. It has little or no competition, insignificant competition. These are all a joke. In terms of cloud enterprise solutions, Amazon is 33% market share in front of all the other competitors. So Amazon has a wide economic moat. So it passes the first two steps, all right? Next, let's look at the debt. Recall I told you that I want the company to have low debt and high cash, right? Yes, the debt has been increasing, as you can see the rate, but the cash has also been increasing in line, okay? Specifically, the debt to equity ratio, sorry, wrong one. Debt to EBITDA ratio, this is the one you need to look at. We want this to be less than 3. The lower, the safer. Recall that Tesla had a debt to EBITDA ratio of 4, which was really scary, right? Amazon's debt to EBITDA ratio is 1.86, much lower than 3, very safe, okay? Interest coverage ratio. How much can the company cover its interest payments from its profits? The higher, the safer. We want this to be more than 3. Recall that for Tesla, it was only 1.8. Scary, right? For Amazon, it's 10. Way above 3. So Amazon is very, very safe. It's got very conservative debt. That's how we read it. Next, we have to calculate the intrinsic value of Amazon the same way we calculated it for Tesla. Now, for Amazon, the projected growth rate of Amazon for the next 5 years is 36%. So we are going to be using this growth rate of 36%. Recall Tesla was 50% growth rate. Amazon is 36%. Okay? Now, Amazon's a white mode company. So with white mode, we use a 20-year discounted cash flow analysis. Now, again, when you join the value momentum investing course, which I really highly recommend you join the course, the Whale Investor course, you'll be getting all this software. You'll be getting all these intrinsic value calculators. You'll learn how to put in all these numbers. It takes me less than 5 minutes to do this, because I get all these numbers from Yahoo Finance, right? These numbers are there, plug it in, you get it really fast, right? Okay. So let's take a look at Amazon's valuation. Okay, so over here, we are going to put in the free cash flow. We're going to be really conservative and put Amazon's free cash flow of 26 billion that we saw just now, 26 billion in free cash flow. Total debt, 33 billion in debt. Total cash, 71 billion in cash. So you can see that Amazon has double the cash than the debt. So it's really, really safe. It can easily pay off all the debt if it wanted to. Okay. Growth rate for the first 5 years, 36%. Next 5 years, we're going to cut it by half to 18%. And for the last 10 years, we're going to put it at 4% as well, which is the GDP growth rate plus 1% of the US. The number of shares are 500 million shares. And this gives us a final intrinsic value of $4,343. 4343. Okay. And currently Amazon is selling at about $3,100. So what does it mean? Amazon is worth $4,343. That's the intrinsic value. And currently the share price is at $3,160. So Amazon is currently 27% undervalued. Can you see that? Tesla was 500% overvalued. Amazon is 27% undervalued. Okay, so Amazon is dirt cheap right now. It is dirt cheap. Okay, but would I buy more Amazon shares right now? By the way, I have quite a bit of Amazon shares. Let me see if I can. Yep, my broker's up. Okay. So like I said, you can see Microsoft over here. So my average price was 146. I bought it during the crash, right? Now it's at $208. Okay. Amazon, where's my Amazon shares? Yeah, my Amazon, I bought it at an average price of 1,008. Okay. And now it's at 3,001. So I'm up about 40 grand on Amazon. Okay. I've got about 300,000 in unrealized profits right now, right, from all these stocks that I bought recently, right? So I bought Amazon at 1,008. Now it's at 3,000 and it's still 27% undervalued. Am I buying more shares? Yes or no? No. Why? Because if you look at a chart pattern, okay, let's look at the charts right now. Let's go to Amazon. Okay, and we saw that the intrinsic value was about 4,003 based on its latest earnings, right? 4,003. So somewhere up there. Okay, so this green line is the intrinsic value. So you can see that currently it is still way below intrinsic value, right? But I'm not adding right now, okay? Why? Because remember the wave patterns? Wave up, wave down, wave up, wave down, wave up, wave down, okay? I only like to buy on a wave down when it hits a level of support. Now over here, you can see for Amazon, right? Wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down. It's now here. Now, there's actually nothing wrong buying here because you could say that it's at a wave down, it's going on a wave up, okay? But personally, I like to buy when I get a bigger discount nearer the moving averages. Now, if you take a look at the weekly candles over here, what you notice is the pattern. Notice that wave up, wave down, wave up, wave down, wave up, wave down. Notice that when Amazon makes a retracement, it finds support at the red dotted line. Can you see the red dotted line there? The red dotted line is the 20 EMA. When it makes a big retracement, like this is a big crash, it hits the orange line. The orange line is the 100 moving average on weekly candles. Okay, so what am I saying? I'm saying that Amazon, when Amazon has a small drop, it tends to find support at the red dotted line, which is the 20 EMA on weekly candles. When it has a big crash, it finds support at the orange line or the blue line or the orange line, which is the 50 and 100 moving average. So based on historical patterns of the wave patterns, where would I buy Amazon shares? I will buy here. Why? Because that's the red dotted line. Can you see that? And I'll also buy here and here. Okay, so I'm waiting for Amazon. Remember, I told you in September and October, I expect a correction. Remember that? Okay, so I'm expecting it to correct. If it corrects to 2,692, I'm going to buy more Amazon there. Now, if there's a bigger crash, which I doubt, but if there is a bigger crash and it manages to get down to 2001, I'm going to buy a lot of it. But I don't think I'm going to get that lucky. I'm only looking at getting in at 2006, adding more before the next hallelujah to $4,000 to $5,000. Okay, so that's how I read it. Pretty simple.
So if you want to be the first to get my next video on YouTube, do click the subscribe button right now. If you want to check out my online courses, go on to piranhaprofits.com where you can enroll in our professional Forex, stock trading, options trading, and value momentum investing courses where you're going to learn how to trade like a professional and generate an income anywhere in the world. If you would like to come to Singapore to attend my live classes, Wealth Academy, go on to wealthacademyglobal.com. It's Adam Khoo, and may the markets be with you.